Welcome to this video. This is going to be a refresher type of video whereby we will be going in depth over key financial metrics. So these are profitability, liquidity, solvency, and efficiency financial metrics, formulas, and ratios. First, we'll have a quick overview over each figure, and then we'll move on to calculate those metrics. So first, we're going to start with profitability. And these items that we're going to be discussing are all found on the income statement of the business. So the first metric we're going to be discussing is the gross profit and the gross profit margin. And these two items pertain to the profit a company makes after only deducting direct costs that are associated with the production and distribution of its products. The formula for gross profit is revenue minus cost of goods sold. So if a company sells a product for $100, but it costs the company $50 to procure that product, then the gross profit on that item, on that product, is 100 minus 50. And the gross profit margin on that product is 50 divided by selling price, which is 100, times 100. So it's 50%. The next item is the operating profit and the operating profit margin. And the operating profit is also referred to as EBIT, which stands for earnings before interest and taxes. EBIT also pertains to core operations only. And this means that it excludes items that are not considered core, non-recurring, or not controlled by the business. And one suggested way to calculate EBIT is to start with your gross profit and deduct from that any costs that are recurring, core, and controlled by the business that have not been included in your cost of goods sold. The way to calculate EBIT margin is simply to divide the EBIT by revenues times 100. The next two items are Ebitda and Ebitda margin. Ebitda stands for earnings before interest, taxes, depreciation, and amortization. It also pertains to core operations only, which means that it excludes items that are not considered core to the operations of the business. It also excludes items that are considered one-off or non-recurring. The way to calculate this Ebitda figure is similar to EBIT. So start from gross profit, deduct any costs that are considered recurring and as part of the nature of the business that have not been included in cost of goods sold. However, you will need to add two key items here: depreciation and amortization. So the key difference between the EBIT figure and the Ebitda figure is the da at the end, the DNA. And that refers to depreciation and amortization. And the reason these are added back is because these are non-cash charges. And a lot of people reviewing financial statements want to see this figure without those non-cash charges deducted so that they could estimate, if they need to, or have an idea of what is the recurring cash flow. In a way, it is almost used as a proxy for cash flow if the cash flow statement is not detailed. Next, we have the net profit and net profit margin. And this is also referred to as the bottom line of a business. And the reason it's called bottom line is because it's at the end of the income statement. This figure is the net profit. It includes all costs, whether they are recurring or non-recurring. And a key difference between net profit and operating profit, and Ebitda for that matter, is that it includes interest costs, it includes taxes, it includes non-core losses or costs that are non-core to the business, if any, costs that are non-recurring, if any, as well as gains that could be deemed one-off, such as a gain on a sale of an asset that is not usually happening or recurring every business cycle. And the net profit margin is simply your net profit divided by your revenues times 100. This is a percentage. Next, we move to liquidity. In order to properly determine whether a business is considered liquid or not, there are key ratios or formulas that need to be reviewed. The first and most basic ratio is the current ratio. So what is the current ratio? The current ratio is a way to measure a company's ability to cover its short-term liabilities. How? By using its short-term assets or its current assets. And these are assets that can be converted to cash, usually within a very short business period. So unlike, say, machines that a business owns, inventory is stock that the business is looking to sell and convert to cash in the short term. Same goes for accounts receivable, which is a current asset that the business expects to monetize or to collect the cash for in the short term. So the way that formula goes is you simply divide your current assets, such as your accounts receivable, your inventory, and your cash, by your current liabilities, such as your accounts payable, for example. And the higher the current ratio, the better the liquidity of a company. That's the key takeaway from it. If you think about it, a higher current ratio implies that your current assets are higher than your current liabilities, which means that it is more likely for a business to cover its current liabilities by using its current assets, given that the current assets are higher than the current liabilities. The next liquidity metric we're going to be discussing is the quick ratio. And the quick ratio is a more conservative metric than the current ratio, which we just discussed, because it excludes inventory from current assets. And the idea here is that the reason inventory is excluded is because it might take longer to sell inventory. It's not something that the business can necessarily control compared to other current assets, such as cash or liquid stock investments. So it's a more conservative metric. The way the quick ratio can be calculated is by taking your cash and cash equivalents plus short-term liquid stocks. So these are stocks that could be treated as cash because they are liquid and can be sold whenever a business needs to, plus accounts receivable. And so the only thing missing from this quick ratio is the inventory. And you divide that by current liabilities. The next item to discuss is the accounts receivable turnover. And this term measures the efficiency of collecting payments from customers. So the higher that accounts receivable turnover, the better a job a company is doing in collecting outstanding payments from customers. So what is the formula for accounts receivable turnover? It is revenues divided by accounts receivable, or by the average accounts receivable. And that could be calculated as taking the accounts receivable at the beginning of the year plus the accounts receivable figure at the end of the year and dividing that by 2. But what is it telling me if I divide revenues by accounts receivable? See, a company can book revenues when it completes a service or delivers a product or invoices a customer. But that does not necessarily mean that the customer already paid for that service or gave cash to the company in exchange for that service. So when accounts receivable as a metric in terms of magnitude are substantial, then this turnover figure is going to be low, because revenues divided by accounts receivable is your accounts receivable turnover. And so the higher the accounts receivable, the lower that turnover. And this means that the business is not collecting cash even though it is booking revenues. However, the opposite also is true, which means that if the business is recognizing revenues and has very little accounts receivable outstanding, it's a good sign, because it implies that customers have been paying. Very little amounts of money are left outstanding. The next figure is accounts receivable days. So this figure is also based on the accounts receivable turnover, and it refers to the number of days an invoice stays outstanding before it is settled by customers. Okay, so basically, once a business invoices a customer for a service rendered, this figure helps understand how long it takes a customer on average to make the payment. And the way this figure is calculated is accounts receivable divided by revenues times the number of days in a period, or the number of days in a given period divided by the accounts receivable turnover, which we just discussed earlier. Because accounts receivable turnover is revenues divided by accounts receivable. And when that figure is in the denominator, mathematically, the way you treat it is you flip it. Number of days in a period times accounts receivable divided by revenues. For better accuracy, you could also take the average accounts receivable figure, whereby you take the balance at the beginning of the year plus the balance at the end of the year, and you divide that by 2. Next is the inventory turnover, which is also a liquidity metric. We are still in the liquidity area here. And the inventory turnover indicates how quickly a company can convert its inventory into sales in a given period. So a high ratio could imply fast sales, meaning that the company is converting inventory into sales rather quickly. And could also mean that the company is having difficulty restocking inventory. And so if we look at the formula for inventory turnover, the formula is cost of goods sold divided by inventory, or average inventory for better accuracy, which means the inventory balance at the beginning of the year plus the inventory balance at the end of the year divided by 2. And the inventory balance at the beginning of the year is simply the balance at the end of the prior year. So whatever that balance was at the end of a prior period is obviously the same figure that you start the current period with. So if the formula is cost of goods sold divided by inventory, because you usually procure inventory at cost, obviously, and you sell it at the price and make a spread on that. And that's why COGS is used and not revenue. But some people still use it as a percentage of sales, or they still use it relative to the sales figure as not the cost. But I think COGS is more accurate. So if we look at that formula, if my inventory figure is high in the denominator relative to my COGS figure, then this implies that I have a lot of cash stuck in my inventory, which I have already paid for. However, if my inventory figure is low, which means that that ratio is high, so COGS, the numerator, divided by a lower figure, that might be a good sign because it implies that the business has already paid for inventory, but that inventory has been converted to cash, which means that the balance for that inventory is low, and so the business has been able to sell that inventory. It's been quick. So when times are good and there are no supply chain issues, for example, then you would want a high ratio. You would want an inventory turnover whereby the inventory balance is low, and the reason that it's low is not because the business cannot replenish inventory, but because it's converting it quickly into cash. Retailers tend to have high inventory turnover ratios compared to other industries. Next is the inventory days, and this is basically the number of days it takes to convert inventory into sales. And that figure is derived using the cost of goods sold figure as well. And the formula for the inventory days is inventory divided by cost of goods sold times the number of days in a given period or year, or the number of days in a given period divided by the inventory turnover, which is the previous metric that we just looked at. And for better accuracy, we can take the average figure for inventory to get a more accurate number of days. Next, we have the accounts payable turnover, which measures the speed with which a company makes its payments to suppliers. So the formula for the accounts payable turnover is cost of goods sold divided by accounts payable, or average accounts payable. And so when the accounts payable figure is high compared to the cost of goods sold, that could mean two things. It could either mean that the business is unable to pay suppliers on time, and hence it has an accounts payable balance outstanding that is substantial, or it could also mean that the business has managed to negotiate relaxed payment terms with suppliers, and therefore it is using that cash rather than paying the suppliers. It is using it for more enriching activities. Then we have the accounts payable days, and this refers to the number of days it takes companies to pay their dues outstanding. The formula for that is accounts payable divided by cost of goods sold times the number of days in a year or in a given period if we're doing it for a shorter period, or alternatively, the number of days in a given period divided by the accounts payable turnover. The last figure we want to discuss as far as liquidity is concerned is the cash conversion cycle. And the cash conversion cycle figure refers to the net time required to complete the stages we just discussed. Selling inventory to customers, collecting payment from customers, and making payments to suppliers. And the cash conversion cycle is calculated in days. And the way it is calculated is by adding the account receivable days to the inventory days and deducting the accounts payable days from that. So let's say, hypothetically speaking, that it takes 20 days to collect payments from customers for services rendered or products sold and invoiced, that it takes on average 15 days to sell inventory or to convert inventory into sales, and that it takes 30 days for the company or for us to make payments to suppliers. Then the cash conversion cycle would be 20 days for accounts receivable plus 15 days for inventory days minus 30 days for accounts payable. So 20 plus 15 minus 30. So 35 minus 30. So the cash conversion cycle would be 5 days. Next, we're going to move to solvency and coverage ratios, and we will get into that shortly. The first item we will be discussing is debt to equity, so debt divided by equity. And this figure measures how a company is sustaining and financing its growth and operations, as well as the proportion of debt versus equity a company has in its capital structure. So the capital structure of a business essentially highlights the mix of debt and equity that is used to fund the business. So this is a form of long-term financing. How is the business capitalized? So besides the debt and equity mix, if everything else is equal between two companies, the company that has a lower debt to equity ratio is perceived to be less risky. However, a company that has a higher debt to equity ratio would be perceived to be more risky by banks. Next, we have the debt ratio, and the debt ratio is calculated by dividing total debt by total assets, and the debt ratio measures the magnitude of debt vis-a-vis the total assets of a company. In a traditional established business, a debt ratio above 1 could be considered a red flag, because it implies that the company has less assets which it could pledge as collateral versus its debt figure. So for example, if a company's debt ratio is 2, that means that the company has twice the amount of assets it has in debt. And so from a lender's perspective, that is not a good thing, because in the event a company defaults on its debt, then the only security that a lender could have access to is the assets of the business, which are worth half the amount of debt outstanding. Next, on solvency and coverage ratios, we have the debt to Ebitda figure, which measures a company's financial health and indicates how well a company can cover its debts from its financial performance. This is a figure that is very commonly requested by both investors and banks alike, because there usually is a standard by industry, obviously, and by jurisdiction of what that figure should be. And generally speaking, when a business has 5 times its Ebitda in debt, then that business would be perceived to be risky, because the business would be considered over leveraged, or the business would be considered to have too much debt. Next is net debt to Ebitda. And the key difference between debt and net debt is that in net debt, you deduct cash and cash equivalents, such as liquid stock that you can sell anytime you want, so that could be treated as cash, from your total debt figure. So the benefit from taking the net debt figure is it also assesses the cash position of a business versus its debt position. So when a business has cash and cash equivalents on its books and it's not starved of cash, then that figure could be used to offset the magnitude of debt it has. Next, on solvency and coverage ratios, we will discuss the interest coverage ratio. And the interest coverage ratio is the earnings before interest and tax, or the EBIT, or the operating profit, divided by the interest expense. And the interest coverage ratio assesses the ability of a company to honor its interest payments when they are due in a timely manner. So this is only looking at interest payments. And when a company defaults on its interest payments, it means that it has defaulted on its debts. Generally speaking, lenders would like to see a minimum ratio, a minimum interest coverage ratio of 3 times, which means that a company would be generating an operating profit equal to at least 3 times its interest expense. Next, we will look at the cash flow available for debt service, which measures how much cash has been generated by a business in a given period that could be made available to service both debt and interest payments for the business. And one way cash flow available for debt service can be calculated is by adding operating cash flow to investing cash flow minus dividends that have been announced and yet to be paid by the business. So when you add your operating cash flow to your investing cash flow and then deduct any dividends that have been announced that are yet to be paid by the business, whatever is left is how much cash you have available to pay for your debt and for your interest payments. The last ratio that we will be discussing under solvency and coverage ratios is the debt service coverage ratio, which includes the cash flow available for debt service figure we just discussed. The debt service coverage ratio is calculated by dividing the cash flow available for debt service by the principal repayment plus the interest repayment figure for the given period. And this figure, the debt service coverage ratio, reflects the ability of a business to cover debt and interest payments. Usually a debt service coverage ratio of at least 1.25 times, so having a cash flow available for debt service that is at least 1.25 times the principal repayment and the interest repayment amounts for a given period is considered acceptable. The last set of ratios and formulas and metrics that we're going to be discussing pertain to activity and efficiency of a business, and you will notice that there are some ratios that we've already discussed under liquidity also available here because they can also reveal information on the efficiency of a business. So starting with the accounts receivable turnover, this is the same figure we discussed under the liquidity section above. This figure also helps measure the efficiency of collecting payment from customers. So the higher that ratio, the more efficient a company is likely to be in collecting outstanding payments, which also means that the company is more liquid because it is collecting receivables faster. It is more efficient in the receivables collection process. The next figure is the inventory turnover, which has also been discussed under the liquidity section above. And this figure indicates how quickly a company converts its inventory into sales, which could also be seen as an efficiency metric. If a company can convert its inventory to sales quicker, it is considered to be more efficient. So a high ratio could imply faster sales, meaning that there's nothing or there's very little left in inventory. But it could also mean that there are delays in restocking inventory. So there needs to be a little digging here to know really what is the status of supply chain and how quickly a company is able to restock the inventory that it needs to. Next, we have the asset turnover, which reflects whether a company is using its assets effectively. So what is this saying? The formula for asset turnover is revenue divided by total assets. So if a company is generating revenue that is far in excess of its asset base, then that's a good thing because it means that the company, in terms of activity levels, it's good. In terms of efficiency levels, it's also good because it's using its total asset base to generate as much revenue as it possibly can. So when comparing two businesses that are identical in nature, the business that has a higher asset turnover ratio means that it could be more efficient in using its assets to generate sales. Next, we have the return on equity figure, which measures how efficient a company is in generating profits or net income relative to its shareholders' equity. So not total assets, which is equity plus debt, just shareholders' equity that has been used or that has been invested to fund a business's capital structure. And the return on equity figure varies from one industry to the other. Generally speaking, having a return on equity or having net income divided by total shareholders' equity of at least 10% for a traditional business is considered good. And the last figure we will be discussing is return on assets. And return on assets is net income divided by total assets. And total assets is equal to total shareholders' equity plus total debt. And the return on assets measures how efficient a company is in generating net profits or net income relative to its asset base. The ideal returns for the return on assets also vary by industry, and they also vary depending on whether the company owns or leases its core assets. Now that we've discussed key financial metrics and formulas and ratios pertaining to profitability, liquidity, solvency and coverage, activity, and efficiency for a business, I feel this is a good start for the rest of our videos that assume a certain basic understanding of such figures. So I hope you found this refresher video helpful, and thank you for watching.